And this is Josh Jelinski, the financial quarterback. Don't touch that dial. Samantha Leduc describes herself as a macro to micro analyst. What does that mean?
Means I look at the big picture and then I drill down to sector rotation and stock selection for clients and put it into actionable trade setups using mostly options. Yeah, so I'm definitely looking at a backdrop of policy dictates price. So macroeconomics is my focus for the backdrop, but there's lots of, I cover all assets and timeframes. So I'm looking at sector rotation for durable themes, and then how to play those by also choosing the momentum of growth or value, and then specific stocks, and also kind of weave in some intermarket analysis, fundamental analysis. Technical analysis is very strong for me, pattern recognition. It's mostly to identify entries and exits. So the long and the short of it is I'm not using one particular silo, but lots of discipline and then blending them together and coming up with market direction, the intensity, the duration, as well as sectors and stocks.
So I like that you're from upstate New York, raised by a single mother. I've had so many people on the station, upstate New York, which you really, if you know it, you wouldn't connect it to like high finance. But we have had so many really great guests. Golisano, the head of Paychecks, the owner of the Buffalo Sabres, he's been on the show. We had the guy with the hamburger. What was that guy's name? The fiduciary guy. We've had a lot of great, I always love the guests from upstate New York. My best friend, Jesse Carlucci, who I have a theory about it. He was born and raised in Lacey Township, New Jersey. Then he moved to Candor, New York, which is somewhere upstate. I have a feeling like you're so bored up there as a kid, you just read, and he got his PhD and now he's in finance, but his PhD is in like paleontology. Describe growing up in upstate New York, and how do you think it made you a better trader?
Had nothing to do with it. It literally, I grew up on a farm, and that couldn't be further removed. So just a lot of kind of pragmatism, I think. And, you kind of get a little bit of sixth sense, I think, by living more earthbound. Not a lot of possessions, not a lot of also interaction in city and overstimulation. So I think this is basically my upbringing is very, very humble, and I stay humble. And I'm in the same house, 26 years that I raised my children that are all gone to live abroad. So I don't desire a lot of fancy or live out loud, but it definitely, I think also being just from an area that's very kind of poor and also relaxed. In other words, not a lot of city slickers do well up there. There's a lot of just common sense that drives a lot of decision making. So I like to kind of think I'm just a farm girl that waded into finance later on in life, much later in life. I had nothing to do with this in my career. So coming into it basically during 2008, Lehman Brothers, I had sold my business a year and a half prior. My son had a medical emergency. I did have my own company, was not related at all in financial services. And it was a family of 60. That's how I like to look at it. And so after 10 years, I sold it because he had a medical emergency and took a year and a half off. When he went back to school, I decided to protect that wealth. And it literally was September 18th, 2008. So since then, I have been rabid in listening and learning and applying everything that I've learned. And it's a great journey. I just think this is fabulous. I get to exchange ideas with folks that have been really diehard Wall Streeters. I am not. I am rogue retail. So being able to kind of link their expertise into how I see the market, and then translating the market in a language that I understand. And then I find clients that have a similar worldview. And so they want my market thoughts and my market calls and my trade setups. So I share those.
That's great. What was your business before Leduc Trading?
Global content management. It really was adding languages to software and documentation and websites before it became ubiquitous to have machine translation and all of this, instant AI enabled language. So it really was the very early beginning of all of that migration into localizing content for international audiences. So very different, very much software and content globalization that right now is a feature. You don't have to pay money for it. It's free.
That's probably good that you got out of that business, right?
Yeah. But that wasn't my intention. It was just the timing of it was literally time to reinvent. And I didn't see another business that I liked. So I learned about the market and I have been learning ever since. And I love it. So that's just basically where I spend all of my time and have assembled a team.
So, oh wait, you cashed out of your business.
Mhm.
How did you get involved with trading?
Just protection of capital. And I think a lot of your clients are probably coming in and some are very, risk averse and they just want protection of capital. Others, they want performance, more like income. They want to keep up with inflation and, kind of match the S&P. That's fine. They don't want to lose money. More so, I work with clients that are focused on absolutely outperforming the markets. So it's much more growth oriented alpha. But in times of volatility, go back to capital preservation. So it really has to do more with full time traders and active investors who are looking out and managing their own portfolios or managing money, managing other people's money. So this is very, very different from where I started.
So, what do you think about right now? The moment we are in right now, are you bullish, bearish?
I still have a bullish bent because of policy intervention. That is what makes the market. So if you kind of think, if your viewers are not active in the markets like myself and clients are, and my contributors every single day, you don't really need to justify why the dollar is moving or yields or equities. You're just kind of in it, right, for the long haul. But for those who are much more active, we're looking at every news headline to identify where the market's going. And we know that policy intervention is the largest reason for the bullish advance. So if you kind of go back and look at the great financial crisis, the 2009 bottom, they came in with lots of liquidity in QE. If you look at the COVID March 2000 and 2020 bottom, they came in with tons of not only monetary dropped rates to zero, but also quantitative easing and lots of fiscal stimulus, right? So this was a huge bazooka the world has never seen. They're still coming in small ways every time we get risk off in equities. They also have incentive. It's an election year, and it's typically pretty bullish, into the election. And this is a very contentious one. And you've got some powers that be that want to safeguard it. So we've had policy intervention, whether it be the bank bailout in March, backstop in March of 2023 to the October 2022 coordinated global financial central bank intervention. They came in again and backstopped the market. We've had it again, even in November 1st of 2023, where Fed came in and said, we're going to pause this, rate hiking regime. And the markets were very excited about that. Shorts cover and it fuels higher. And then they came in recently, as you know, on September 18th, Fed Day, and that FOMC decision was a 50 basis point cut, much, much higher than expected. They shocked the market, which is not their usual MO. And it again is all about safeguarding equity returns, which is what we watch, which I watch very closely, is where are we going to get the next policy intervention? So as long as they are very active in supporting markets with easing, and they coordinate with Bank of Japan and others, and then we saw what happened with China, lots of stimulus, right, and monetary easing the past 2 weeks, that triggered a historic rally in China equities. That's policy intervention. So that's my focus. So yes, I am bullish as long as policy intervention continues to work.
No, like next year, what if we wake up and they say, you know what, we were wrong on inflation. It's remaining stickier. We're going to have to pause the rate cuts, or we're going to have to do something. We're going to have to increase rates again.
They're putting themselves more and more in a kind of precarious situation because their tools are fewer, but they're still working. We would not be going higher if we didn't. So, for example, they do not control the oil market, but the White House has some tools of intervention. And they do not control the labor markets, although they can ease and tighten to kind of tweak it. But for the most part, this is another worry for next year. We just got non-farm payrolls out this morning, right? And they were very strong. Good news is good news. The market likes it again. But a Fed that then becomes data dependent plays with the market, emotions, because instead of having a defined path, the Fed is hiking. Okay, now it's a defined path. The Fed is pausing. Now it's a defined path, right? Of the Fed is cutting. Now all the macro folks are kind of like, okay, how much and why? So the things that they cannot control, as it relates to the long end of the yield curve, as it relates to labor and oil, those are things that can come up and create a lot of friction in the market, like what happened in July into August with the yen carry trade unwind, which was very, very, very strong current where funds, big money, are actually short treasuries and long NASDAQ. They're using that rate differential between the US and the Japanese yields to borrow low and then invest in higher yielding equities and assets. And when that became unstable, we had a massive, very short duration pullback of 15% in NASDAQ, for example, right? This is when we have this intervention again that reflexively allows us to bounce up and move higher, supported by policy intervention. So this is where you can see that they have an ability to lose the script sometimes, and then we see this volatility outsized, but then they come back in with the next play. And the next play was, we're gonna cut not 25 but 50 basis points. So this is what I mean by, you can see it when we have disruptions. They're going to come in and do something, and it does have a diminishing rate of return, but it is still working. So that's what I'm always looking for, is what's the next risk event that's going to trigger volatility. And right now we've had some little tremors in repo market, which is basically a facility that says there's some liquidity deterioration. And then what would the Fed do in response to support, again, equities from having volatility create price repricing of assets, which is what they don't want to do, especially before an election.
Explain the repo market for our listeners who maybe not, you hear about that word, but.
So if you have liquidity that right now is abundant, and right now we do have it in the market since the COVID, extravaganza, and it's coming out now, some of this in the form of the Fed balance sheet. And some of these facilities, by the way, have been invented to support banks, right? Like the BTFP, which came in the Silicon Valley Bank failure. And these are facilities that basically allow banks to keep functioning. It's critical. Banks are more important, believe it or not, than tech. So as long as we have banks stable, then tech can continue to grind higher and focus on earnings. And that's really what we're looking at. And this is also kind of one of the reasons why the Middle East conflict has not scared the market as much. Earnings are very important to equity returns, and they don't really know how to price in the future earnings from a conflict, for example. But the repo market is instability in the banking system. It's a search for liquidity. And this is one of the reasons I think right now we have a very small tremor. We'll have to see if it percolates higher, where the funding facilities become stretched or limited, and somebody's in trouble. We don't know. It's kind of a shadow, but we can see indicators. So long story short, this is not something that's been on the radar for weeks and weeks and weeks. All of a sudden, there was some disturbance at quarter end, and it continues to kind of play out. And so it's another thing to be aware of. But big picture, the market is very robust, based on earnings, based on strong labor, based on economic, data points that keep coming in that say we're pushing out in recession, and the Fed has our back. They keep coming in and facilitating easing and or bank lending liquidity if there's any sign of stress. So I'm not really heightened on the repo thing. I'm just saying it has started to trigger. And the reason why I'm focused on it just the past few days, honestly, is because the last time we had a major repo event was in 2019. And it ultimately was caused by a very strong yield spike and an oil spike. And right now, I don't know if you've noticed, but since the Fed actually started cutting on September 18th, we've had a yield spike, which I called, which was kind of cool. And now we're having an oil spike as it relates to the escalation in the Middle East. So the combo deal may, de-escalate and, calm down. But right now, the repo market is just a little bit shaken.
What's the next shoe to drop? 6 months? What risks do you see on the horizon?
Yeah, 100% would be the labor market. So we kind of get this, it starts right after all of this liquidity has exploded into the market. We start with these kind of global rate cuts after they've waned, right? After the effectiveness of all of this liquidity and easing starts to have diminishing rate of return. We start to see that banks are actually not lending as much. Global credit demand is falling. And the way that we can see that is through central banks cutting interest rates. So we were already seeing central banks kind of cutting, in some cases, very aggressively, and in advance of the Fed announcing finally that they were going to cut, and then the 50 basis point extravaganza. So the issue is that why would they start cutting if everything's so, rosy? Because global credit demand is falling, period. And we do have some indicators of economic growth slowdown. And right now we have an election year. If you can really get excited about the labor print or maybe mistrust it a little bit, but ultimately that is the one big indicator of stress is higher jobless claims, unemployment rate rising. Obviously, we're at 4.1% right now, so no one's worried about it or thinking about it. But I am for next year. So I'm looking at how yields did fall very, very strongly in Q2 to Q3, very strong with oil. And I'm actually still big picture an oil bear and a bond bull, which is yields falling. But not right now, because we had to have this relief bounce again, protect equities, protect the bond market. It's in play. It's an election, one more month, right, into the election. Next year, there'll be new policies, and that will also create some more de-risking. We have this very, very outsized bet in concentration risk, which is the Magnificent Seven, right? The NVIDIA and the AI and all of that wonderful future growth that's been pulled forward to the tune of making up a ginormous amount. In other words, their market cap makes up a very large amount of GDP. So that's a little unwieldy. That de-risking next year on falling yields, on falling oil, on more carry trade unwind, which is not, by the way, just yen carry trade unwind. It's also oil carry trade unwind because they're betting on it going higher, and it's not been the past few quarters since April. And then most recently, this escalation in the Middle East has spiked oil. But when it resolves, it will fall back down again. So these are counter trend moves, but big picture, oil is weakening, yields are weakening. That's a deflationary impulse worry. But right now, with Fed cutting, the narrative changes to, oh, we're going to have inflation again. And then they think this is really in play because yields are spiking. So there's a lot more involved in positioning and the big funds that are actually unwinding some of these large positions because of yen carry trade, oil carry trade, and the treasury carry trade. So this is how we kind of look for the waves in the market and the policy intervention that supports it, and then the risks coming up, whether right now it might be a little repo, but what happens if we do have another 2019 type of repo event? Right now, we don't have any reason to worry about it, but if it does come in, what did the Fed do last time? They exploded their balance sheet and they started doing QE again, stealth, and then actual. So they're right now in quantitative tightening. They've actually taken about 40% of the assets down since the height, and that would stop. They would stop tightening. They would stop running off the balance sheet. They would stop and they would start doing QE again. So they still have lots of recourse for when we get into hot water. And that's in large part why every dip has continued to get bought until their policy intervention stops working.
I would have thought the Fed really lost its credibility in 2022. Remember 2021, they kept saying inflation was transitory, and they kept saying it, and they kept saying it. And you started to believe it, right? You started to say, hey, it's always going to go up. We're just going to have them come to the rescue every time. Then all of a sudden, 2022 hit, and that bear market from January 22 to about October 23 was very painful for a lot of people. If I'm a betting person, I would see it maybe happening next year, but I have no clue. I just didn't know if you had any thoughts on that.
So we actually had a lot of selling underneath the surface in November of 2021 before the pullback in 2022. So I could actually see that breadth was breaking down underneath the surface after this exuberance, right? And this was very, very obvious as it related to risk coming in through de-risking. And it looks so innocent until you actually study the intermarket underneath. And the breakdown is very stark. So they start selling underneath the surface. It becomes a sold to you market, if you've heard of that. All right. So literally in January 9th of 2022, I said, this is also a situation where bonds are still falling. Wages are not outrunning inflation, and productivity is falling. That's an enemy of bonds. So long story short, stocks and bonds will fall back. And a baseline bet would be a 20% pullback in SPY. We did get it. We got a 35% pullback in NASDAQ. It took the whole year. But the point is, this was an unprecedented kind of event where in August of 2020, right straight through into most recent May of 2023, we had a dramatic pull down in bonds and obviously advance in yields. So the one thing that I look for is when this is very positive for the markets. In other words, a yield spike can be not a yield spike, that's the wrong expression, but rise in yields in the case of the bond market pricing in, right, more inflation, and then the Fed doing its rate hikes. There's a benefit actually to inflation. There's a lot of inflation harvesting that can take place, especially with the wealthy and companies with lots of cash. And our assets that we live in, our home is our most inflationary asset. So we have this benefit of really this economic stimulus from the fiscal side, in addition to inflation, inflating equities, inflating home values. Heck, remember what happened to used cars? But lots of money is made sitting there, lots of bigger returns that are you can literally harvest inflation. It's very beneficial. But unfortunately, over history, it doesn't last very long. We get these deflation impulse, or disinflation then turns into deflation. And that's what the Fed wants to protect against. The Fed can actually create inflation, but it's the worry is deflation. So I think right now, this recent reversal higher in yields from that 3.6 10-year into where we are about 4% is extremely wanted for the equity market. So it creates some stabilization. And I don't think that is without coordination or orchestration. I think that was actually intentional.
I'm going to ask you later on, we're going to go to some audience questions. We're with Samantha Leduc, LeducTrading.com. Make sure you follow her on Twitter, on X. So we're going to go to the listeners. We got Sandeep. Go ahead.
Two questions, actually. One, how do you see US Fed action or plan of action getting confused with the massive China stimulus, right? Because on one hand, that will potentially lead to commodity inflation. And if that is the case, ideally, US should probably go slow because the inflation will again probably pop up. That's one. And second, if you're comfortable, what's your view on NVIDIA now?
What was the first trigger for inflation? Was it the strike?
So I meant to say, because China did this massive stimulus, right, which really popping up all commodities. So that makes Fed mandate little tricky again, because they would have thought like inflation is under control. So how do you see China, making things complicated for what Fed wanted to do in, let's say, next 6 months?
So China is fascinating because I have an economics contributor that I work with on my team of 10, Jeffrey Fouvre, and he has been completely bullish on China before this most recent, announcement on the 24th of China doing, monetary easing, as well as followed up with promises of fiscal stimulus and lots of support for their capital markets. And he said, as I asked him, I said, can you give me kind of a summary after this historic advance of 2 weeks, which we timed really, really well? I said, can you give us a reason to stay bullish China stocks? And this is what he said. He said, I think the question is the other way around, that there was no reason for fundamental bearishness on the Chinese economy. So contrary to what you kind of get in media and such, there is a lot of consensus that China is in deflation and hurting badly. Whereas their leader said, no, we're actually going to have a 5%. IMF actually said they're going to have a 5% GDP. Now, I know no one really kind of believes that, but he studies that space extremely well. His portfolio focused on China was up 204% this week. He's extremely bullish China. So this is actually another kind of supportive mechanism for global economic growth. However, they have to follow through with stimulus. So promises are one thing. This is not 2008 where they really came in with stimulus to the tune of, I think it was 38% of GDP. This is a very small amount so far that they're stepping in and they're supporting markets. It's also right now done the opposite with their yuan. It got a little bit too strong, but for the most part, the market in China and the real economy are not the same thing. And sometimes they connect with liquidity, which is what they basically brought in, and it is very bullish. This short-term China rally is a parabola that needs to, correct and retest and base and move higher, prove that it can move higher. China has to prove that they're going to come through with fiscal stimulus, not just the measures they've announced in the past 2 weeks. But this is definitely helping the backdrop of economic growth, which helps the Fed. They don't have to cut as aggressively, potentially, but I still think they will be on a path of cutting. And I think banks will kind of lead the way in pushing the Fed to cut. Citibank, for example, came out early and said they were going to do 8 consecutive meetings of cuts. There are some really strong cases that this backdrop of falling global credit demand, which is another reason China also did monetary easing, is because it's a worry that they have to get out of this deflationary threat. So I know it doesn't seem that way, but that's to answer your question, long story short, about commodities. They ran hot, and I don't mean precious metals, I mean industrial commodities ran hot on this China stimulus, no question about it. But have they actually followed through with the fiscal stimulus? That's still to come, they say. So we really have to see that happening before I think we have a viable fundamental case for a commodity rally. Big picture, I'm very bearish oil, and I think yields will have another retest lower.
And are you bullish on China?
I said it has to prove itself.
Yeah.
So
I don't know. I studied that thesis for years. I always look at K-Web because that's sort of the ETF that I've owned that over the years. But I always look at how K-Web trends. It's still in that basing structure. It would have to hold, I think, kind of push above 40 and hold. But I don't know. I've been burned by China so many times in the past. I just find that it's such
you didn't have me. I know, but you didn't have me timing it. So
I bought K-Web at 18.
My fundamental read on it is extremely poor. That's why I'm very glad that I work with Jeffrey, who has a very focused attention on the macro and the fundamental backdrop of China. I mean, the granularity is unparalleled. Knowledge of the property market, the oil and EV transition that they're going through, production and consumption and trade balances.
That's the problem I have with China, though. No matter what the fundamentals are, the CCP can come in and they can derail what you're doing in a heartbeat. I mean, everybody knew Alibaba and Tencent and all those companies are great companies, good balance sheet, great price to earnings, all the multiple, but to me, it's just, where's Jack Ma? Jack Ma's missing. I don't know.
This is a backdrop of a lot of folks are skeptical. And I am technically speaking, this has hit the wall for this particular rally. And so price drives a narrative, right? This was already a fundamental strong case for Jeffrey. me, it was technical. For me, it was 68 for BABA was extremely oversold. It was the IPO price in 2016. It's actually when Jack Ma came in and did a buyback, even though he's not active anymore. When the CEO came in and did a large, at 3 times of Jack Ma buyback, that was back in January and February of this year. The point is, those are some reasons to get technically excited about China putting in a bottom, but his research is much, much more detailed for more institutional clients. I'm just saying, technically speaking, it was a fabulous rotation that we played for 2 weeks. I think it's hitting its head on a very strong resistance level. But if we get above it, it's still going to be hot fire flames, but it needs that fiscal stimulus by China to kick in. And a comment that he also mentioned, which I think is fabulous, on BABA is actually doing phenomenally well. It just isn't on the radar because so many people have been hurt by it.
Oh, it's a fantastic company. I mean, I use AliExpress on occasion. I mean, it's a great app. But I just have a problem with talk about political intervention, the risks there, and giving money to the Chi-Coms. I have a problem. But
the timing of that stimulus by China was on the Chinese Communist Party's 75th anniversary.
Yeah. And I also think the biggest bullish influence, to be frank, on this whole move in Chinese stocks was David Tepper going on CNBC and sort of spilling his cards. But if you go from the date that he spilled his cards, it really took off. Some of those stocks.
Yeah, it came after, because I run a live trading room for 2 hours every single morning, and literally Monday morning sized up 3 additional China trades because they looked like they were going to go into a squeeze mode, not having a clue that China was going to come out with their mini bazooka Monday night, Tuesday morning, and then follow it up with even more stimulus Tuesday, Wednesday, Thursday, and Friday. And then they went away for their Golden Week in Hong Kong, continued to play all these Chinese ADRs, and they have been hot fire flames. So Tepper did come in, but it was 2.5 days after the stimulus was announced to kind of take a victory lap, that he was very bullish. He was already positioned. And, again, he's aligned with my Jeffrey, Jeffrey Fouvray, who works with me with institutional clients. They've been waiting for the match. They have been waiting and patient. They knew stuff was grossly oversold. They have been waiting for this news, and they got it. And the money flow that came in to the China sector in the past 2 weeks has been historic highs. So it's parabolic. It needs to digest. It will. But big picture, we've got to see if they're going to follow through with the fiscal. And if they do, it's going higher.
I don't trust anything from China.
I'll give you his price target on it. Mine was 120 from 68. I thought I was high. And we know it's already hit 115, right?
No, it's 200 probably, right, with the fundamentals? No, but I've been studying those numbers for years. Part of me feels Tepper and those people are throwing in the towel, and this is their exit event. That's my own.
That's always a thing. I think that there's a lot of sold to you in NVIDIA. That was part of the question that was asked. There is a fabulous, celebrity CEO and the most successful company of all times, but you also know that Druckenmiller and others completely exited. And right now it is waiting for the next, trigger to move higher. And semis right now as a group can definitely move higher with a backdrop of a strong labor market. So I'm not bearish NVIDIA with the macro backdrop of a secular move. Cyclical bid because of this bullish backdrop we have right now into election, into year end. Corporate buybacks come back, with a flurry October 25th for Q4. That's traditionally given us that kind of Santa rally. And then if we do have further policy intervention, whether it be Bank of Japan, whether it be our good old Fed or Treasury, Yellen comes out at the end of the quarter for November 1st. What's that going to be? That composition of bills versus notes and bonds to finance our ever-growing fiscal deficit. These are things that are all going to be watched closely to see if we're going to get more support for an equity advance. And then, of course, NVIDIA being the darling always will lead, and its cap weighting is extremely instrumental in the NASDAQ and SPY for that matter. So if you look on September 11th, just a few weeks ago, the market was really made by NVIDIA. its advance single-handedly contributed to 55% of the day's gain. So it's very important.
It's
No, it's
remarkable.
but that's because it's unwieldy also. It's very, very large. So imagine if we were to get a negative earnings print or a negative anything on NVIDIA. The air pocket of risk lower is also dangerous. I don't see that right now. I still see the market moving higher. I see semis moving higher. And NVIDIA, of course, is the leader of the pack. But I also see some other opportunities in semis that look fine as well, Dell and AMD. So I haven't ruled out that this is not going to be a top, though. So I still see semis in distribution. And I have mentioned this recently, last quarter, and I warned in July. And we have not made any new highs except for Meta. Meta is the only Magnificent Seven that has made new highs. But the point is, I still see semis in distribution second half of 2024 and the first part of 2025. So, but we got to see what happens. Yields falling, not good. Oil falling, not good. Jobless claims and unemployment rate rising, not good. Right now, we only had 2 out of those 3 that threatened, and then they popped up like daisies.
What were the 3 again? You're looking at oil falling.
Yields 10-year falling. If we get and stay below 3.6, then we're in trouble. If we get and stay below 65 in crude, we're in trouble. And then the third leg of the table is jobless claims. If we get and stay above 267,000, we're in trouble. We have only come close to oil and yields, and then both of them got firmly defended. So the market's still bullish until the trifecta is hit. I firmly believe that.
On your trifecta, what's up with the SOM rule? Do you put a lot of stock in that or not really?
The rate of change in the unemployment rate, that the 3-month rate of change that Claudia Sahm had invented, and it works. And I don't see any issues in dismissing it. But it only triggered once and then quickly, retraced, right? So we hit that 4.3%. That we did, by the way, immediately trigger volatility. And I said we would, like that would be the trigger, is if we hit that SOM rule just by default, there are certain portfolios that will de-risk. It's just a thing. So in the same way that when we have VIX go back in backwardation, there is a trigger where portfolios just immediately de-risk. Doesn't mean they're going to buy, it does not mean they're not going to buy back. But the point is these create some tremors in the market. So I look for those. So yeah, I think the next time we hit the SOM rule, we'll have volatility again. But it has to confirm. It has to, like any stock, it has to, right? It has to retest. It has to, test. It has to confirm. It has to move higher. And for that, we do need degradation in economic data here in the U.S. And the strike, right? The longshoreman strike has been pushed off to January, if at all. And we definitely have small businesses suffering more, according to the household survey, large less so. But until we get that trigger, the market is going to stay supported.
So you're a big technical analyst. I love TA. A lot of people think it's hocus pocus. Give your defense of technical analysis.
Price is the auction of buyers and sellers. And I really love to see on a chart this action between buyers and sellers. And you can see when it's absorbed and buyers are ready to resume, right? They've absorbed the selling pressure. A lot of times you can see that with new all-time highs, right? So it has a memory. I love trend trading of breakouts into all-time highs because there's no resistance above. And we've had a lot of them, by the way, in the past few years. It's been phenomenal rotation in lots of sectors. So the memory, if you will, of literally that relationship is shown, depicted graphically on a chart. So I love to use time frame congruence, which is I look at the hour, I look at the day, I look at the week for the same stock, and I can tell where there's a lot more activity, right, from a smaller time frame, and I can see where there are trends on the longer time frame. And I kind of equate this to the hour time frame as a child running about. The day time frame is the parent, a little bit more controlling of the child. And then the week time frame is the grandparent who has authority. And if you go out to the monthly, which I do on occasion use because that's a really big picture, like I just posted on the China trade where we're hitting a major monthly trend line. That's like the great grandparent. So you really have to respect that resistance level, which happens to be a trend line. And when it gets and stays above, it's all systems go. So we can really test these levels for weeks and months and sometimes years before we have these breakouts. So that's what I see in technical analysis is a fabulous way to identify entry points, low risk entry, and then project price targets. Some people don't like that. They don't feel comfortable doing that. I'm completely comfortable in doing that. So I like to be able to create a technical analysis roadmap for clients where I say, this is a low risk entry short. These are my price targets. This is an overshoot, right? Did that recently on the bond pullback, and that has worked beautifully because I had my macro thesis. But the point is, I have a strong technical analysis pattern recognition framework that is for trading. So macro is to come up with a narrative to fit the price. Fundamentals aren't going to make the price. That's already baked in. The fundamentals are in the price. That's just a layer of support. You take a case and you're basically looking for the bull and bear case, right? What I do in technical analysis is I literally try and size up. If I'm bullish, great, this has to happen. If not, this is where I'm wrong. So that's what I'm doing in every call that I make. So, and I post some of that on Twitter, as you know, right? And I have a Substack and I have a website with clients and I run a live trading room. So I'm really, really on record every single day. And I've got 10 contributors that work with me and they all have their own approach of how they size up the market. Very different, right? Jeffrey is very fundamentally and macro focused, bonds, precious metals, etc. I've got a derivatives trader who's a mentor on options, and he's looking at skew and the gamma and the gex. So everyone has a different approach to how they view the markets, and I love it. We all kind of share and blend, and when we're aligned, it's very powerful.
So with technical analysis, what are some good rules of thumb that you like? I spent a lot of time with a great technical analyst, and he had these little quips. I was able to distill them from him after like years of working with him. He had this one thing: never buy a stock under $10 a share, and that was a good rule of thumb. And we would plot and we would like keep a list of all his calls, right or wrong, where you'd go in, where you wouldn't. He always talked about price octaves. He loves price octaves. I don't know if you got into that. And there was some big truth there. So like if a stock pushes, I'm thinking of like Costco, right? 500, it holds at 500. It holds at 500. Once it broke 500, he's like, it's going to hit 1,000.
There are some absolute great trading tips, like if 80, then 100. I love that.
Yeah, stuff like that. I love to hear those things. Of course, they could be wrong.
I have a few. I mean, one of mine is don't short all-time highs and don't buy all-time lows. Folks seem to be wanting to get in there. And again, everyone defines their time frame differently. If you're chasing, you're intraday, you're on a smaller time frame chart. If you're swing trading, I consider that the daily chart. If you're trend trading, that's the weekly chart. But I really like stocks that behave a certain way. They're more predictable. They're very liquid. I don't like illiquid, low-priced stocks. Crypto, forget about it. But as it relates to the 10-week EMA, that's a fabulous indicator to put on a weekly time frame to see if price is above or below. That's great. And if it's above, and it's done nothing wrong. It can still have some reversion back to the 10-week, but it needs to hold that 10-week, consolidate there to move higher. So the 10-week is a really big one for me. And another is ascending or descending 200-day. I mean, I've got a whole bunch of them, but these are just really simple ones. So a lot of So a lot of folks want to buy an oversold stock. And unless you know something, unless there's a reason, right? You kind of come out with earnings and they've announced something awesome. Or you have a short covering rally, which is hedge fund factor rotation. This is a sector rotation that I look for, where shorts are covering the junk and they're having to sell their winners, their VIP. We get into these series of those types of rotations. They don't last very long, but they're very, very powerful. Part of the China rally was fueled by short covering and a gamma squeeze in options. because of the macro trigger of monetary and fiscal, right? And the fundamental story that these stocks were oversold and undervalued. So that was the perfect storm. So I really like when a 200-day, if you're bullish, price is above. It's really important. It can pull back, and then squiggle around there, but it needs to get back above and in trend above that 10-week, or else it is at risk of flattening and rolling over. So it isn't that it's above or below the 200-day. That's not it. It's that it's trending above, and that's bullish. And then if you are looking for an oversold stock that's popping up, zoom out a little bit and see if that 200-day, it's not going to stop going down just because you've had a mammoth short covering rally. Guess what? That price is going to revert right back down to the 200-day. And it's going to take a few months before that bottoms and starts to move higher again. So I think on a time frame of weekly, that 10-week EMA is key. And on a daily, don't get so excited about, a big short covering rally that's going to stick around, like a Rivian, for example. Rivian looked fabulous. Amazon owns like 7%. It got a VW, infusion of like 6 billion. It still took out the lows. It's not done basing. It's still not safe. The 200-day is not going up. So those are kind of basic. And then just don't short all-time highs or buy all-time lows just because you think it's done. It's got to prove itself. I'm patient.
I love listening to him because I found some, like the Gann rule of 4. You ever get to do that one?
I'm not into DeMark or Gann, honestly. I love when traders share their stuff and it aligns with my stuff and they're using a completely different method. I'm okay with that.
I like a gentleman who I know who has studied Gann. Now, I don't know about necessarily Gann because it's how it's been distilled to me from this particular mentor. But, this summer, then we pushed up above the threshold for the 4th time, boom, and off to the races. So there's things that Gann Rule 4, I think, is a good one. The price octave thing is big. And it's you probably do it, but it's like he had some variables. It's like 12.5, 25, 50, like you're 80. 80 pushes 100.
Hey, sometimes simple is best, right? And sometimes it really keeps people just kind of rooted to pick something. In other words, I know some Fibonacci traders. They love Fibonacci. They become experts in Fibonacci. I think there are tons of ways to make money. The trick is not to lose it. There are tons of ways to read the market. The trick is to be able to discuss it in a language, to understand it, not to discuss it, to understand it in a language that you understand. So to me, I have my own, everyone has their own methods. There are some who don't have any. Those are the folks that need help. But for the most part, this all is, the game that we choose to play and how we want to play it. There are lots of ways.
Do you like time counts? Do you look at
Nope.
the days like some of the people do,
Nope.
24 days
Nope.
or this day? So you're mostly price and the moving averages, things like that?
I have
Exponential
lots.
moving average?
They're all off the shelf, but it's easier to show it than it is to talk about it. So
Okay.
honestly, there is just a pattern recognition. I'm sitting in front of my computer 12 hours a day, and I run a live trading room 2 to 3 hours a day. So the ability to look at many, many, many charts and then see patterns and then be able to also compare that with option activity, which is very important. Options are the flea on the tail of the dog, and they can absolutely make the market move. There's no question in my mind. So it isn't about technical analysis in itself or fundamentals or macro or intermarket. It's or options, which is, the quant side of it. It's having knowledge of how they can interact and affect price. The biggest one is policy intervention. Policy intervention is absolutely needed for market health to continue and earnings to continue. And right now we've gone through our big inflationary, spiral higher that helped also pull wages up, and wage inflation has helped delay recession. Wages are now softening. They're about 4% year over year, but inflation is not going down. So mainstream, as we know, right, our bills have not gone down. They are compounding, they are entrenched. So the wages are lagging. So this right now is where we have to kind of start looking at what other Fed policies are going to come in to backstop potential problems in banks, potential problems in the labor market with corporations having less earnings moving forward into the new year. And right now, one of the big areas to kind of keep an eye on is quantitative tightening. They have been running off their Fed balance sheet. If they stop that, then that's also very much kind of a bullish wind in our sails, and we'll see it. Market will just react very quickly to that. But inflationary spikes right now, I don't think are the main concern. And I don't see it. I don't see it the way that I saw it in 2020, 21, where oil was the inflation hedge of size. And we, just have really, really, I think, come back down to earth as it relates to yields and oil, and commodities are going to play that game. And I think we're going to actually have some more growth scares in the new year. But come hell or high water, they're not going to let it happen in an election year. So, make hay while the sun shines, and then we'll, to use a farm, and very much plan for it next year. I know folks are, like you saw the Tepper interview, he's all excited if we get a split, government. That's very bullish. That wall of worry is just able to be climbed. But we also have policies around taxes that are going to potentially hit not just corporations, but also these capital gains that may trigger some end of year selling of size, right? So those corporate tax cuts that Trump did, they expire. Harris has already said they're going to, she's going to be a lot more tax hike focused. So the capital markets will absolutely respond to that through selling. And the Fed is not going to be able to control that. They can't control fiscal deficits. They can't control tax policies. They can't control the labor markets, oil markets, yen carry trade unwind. They can come in with their intervention of easing, to kind of backstop and the, lending facility programs. Again, they can coordinate with Bank of Japan. They got a new sheriff, by the way, a new prime minister who came out very hawkish and then all of a sudden turned it around. And this week we've had a very bullish backdrop because the yen has fallen and bonds have fallen, and that has supported the equity relief. But for how long? So I still think technical analysis is just one, tool in the toolbox to use to kind of identify where market is headed.
And you can find more about Samantha's work on LeducTrading.com. That's LADUC trading, TRADING.com, right? And follow her on Twitter, Samantha Leduc, and the Substack is called Macro to Micro.
It's just at SamanthaLeduc.com.
I didn't ask you this. What opportunities do you see right now in the markets that you like? What trends, what sectors, all that stuff?
One that has already worked out was this yield spike, right? On Fed day, they cut. Folks were a little confused, but it was already priced in. So that morning, I put my position out there that yields were going to spike, and we still are. So bonds are coming down. I think they have some more to come down, which is also yen is falling. Gold and silver are still very, very strong trend longs. The miners are also very strong trend line longs. They have a high beta to the market move, but also they perform really well in a period of when dollar is, a little devalued. But we have inflation backdrop. They do really well. The bond proxies also came back down, which had been very strong swing longs. This is the XLD, the XLP, and you can kind of see that has softened very nicely. Next, because bonds came down as yields spiked, I have two plays in particular that I'm focused on right here, right now, which is an oil spike since Tuesday morning. So in other words, oil moving higher. Middle East conflict was the trigger in large part for the potential of the outperformance, but it actually was already short covering that needed that Middle East news headline to force a cover. in the short-term shorts, the speculative shorts. So that really helped the oil, and I don't think that trade is done. So I think right now we're in a counter trend move higher in refiners. Valaro set that up yesterday. XLE, we set that up what day is this? On Wednesday, day before, actually Tuesday, Wednesday, doesn't matter. Point is, there are a bunch of energy trades right now that are bullish and they're still in play. And I think they can run for a few more weeks. I think the market will run into, I've got some price targets for a while that haven't hit yet. Was 58, 58.20 and 6,010. And I know a lot of people are much more bullish than that, but I need to see the policy intervention.
On which ones?
58.20 for SPX, sorry, and 60.10 is the overshoot for SPX. If we get more policy intervention, we'll move higher. I see semis right now, this cyclical rotation, which is growth. It hasn't really triggered yet. In other words, we came back and we bounced. We had a very strong reflexive bounce. And, NVIDIA did a great job in moving up to that kind of 127 area, but I'm not talking about just NVIDIA, SMH, right? Short-term price target of 270. That's an easy one. NASDAQ short-term is 495. That's an easy one. Apple has 235. So there are some short duration growth, long price targets that I've given to clients the past 2 weeks that we're still working on. In other words, there's meat left on the bone for SPX, NASDAQ, Apple, SMH, XLK. Those are your growth, your cyclical moves higher on a strong labor market. Does that make sense? And then separate from that is the energy rotation, not because it was ignored, because you usually think growth is outperforming value or vice versa. But right now, oil is getting a bid because of Middle East conflict, triggering short covering, and it doesn't look done. In fact, it looks a little scary. So I want to have that on, if nothing else, as a hedge. So that's a sector of energy. I am not an oil bull. Big picture, I'm an oil bear. But this is a counter trend rally. Hopefully that makes sense. And I'm a bear for semis next year, but not into year end. Hopefully that makes sense.
No, that makes sense. I actually agree with you most on everything so far, except the China
know.
thing. But no, fundamentally, I'm very bullish on China. It's just your policy intervention applied to China. It just scares me. It's a nice. I always look to energy. I also think it's running higher because it's anticipating that if Kamala wins, they're not going to have this abundant supply anymore. That we're going to kind of go back to normalcy. I'm not an oil expert, but I know they've been flooding the market with oil for a couple of years now to combat inflation. They'll have to stop doing that eventually. So I think the market's kind of seeing ahead to maybe next year.
I have, as part of my 10 on my trading desk, Bob McMahon, and he is an oil trader, and his father was an oil trader before him. And so he's very connected, and his clients are all physical oil. So it's very much his wheelhouse. And he, by the way, does not have my bearish take on oil. This is mine. This is really, really mine. But as it relates to energy independence here in the States, and that's his. And as it relates to the policy intervention, he calls it the intervention collar. So the White House, the Biden-Harris, administration, they do not want oil to get out of control higher for the reasons you just talked about, right? That inflationary scare, and it's very crippling to the economy. They also do not want it to fall too low. There are advantages to keeping it range bound. And so far, they have come out every time that the market is about to get too hot, they come out with some false Venezuela headline. Seriously. And they are able to manipulate, calls with Saudi Arabia or, the headlines, the SPR. They have been able to manipulate so that we are in a range. And the range is an intervention collar. Long story short, it's policy intervention. We do not have a free market of price discovery in equities, let alone in oil. If we did, I think we would find that demand, because there's also this interplay of demand destruction always trumps supply interruptions. So we have right now a potential, supply interruption, but for the bigger picture, oil is a mobility trade. And when a country or more are in a conflict, it actually reduces mobility. When the home industry, right, was locked and we're not, experiencing lots of selling, it's absolutely demand suppression. The point is, we don't have a big explosion of demand to justify the oil price we have, if truth be told. So I think and we have lots of alternatives. You've seen what's happening in China. Their mandate to go EV by 2030, they're by 50% of cars must be EV by 2030. They're way ahead of that. So their transition to electric vehicles is just really putting Europe and the US to shame, how strongly they have pushed into this new regime. So they're not dependent on the petrodollar, right?
And they're pumping nuclear, nuclear is
yeah,
big.
that's a trend long since 2020. And I'm still extremely bullish that space, but it takes a long time. And you saw what happened just last week when Microsoft, the headline that they were going to invest in 3 Mile Island, right? That takes a few years, by the way. That's not going to be felt right away, but you saw what happened to uranium stocks. So the point is, I think that oil has some substitutes. And I definitely see Robert's point about the intervention collar. But should they lose that base, then I do see oil falling down strongly. In fact, I can see 40 next year.
I am amazed. I came into the business, 05, 04, 06, kind of 08, how so many people today who call themselves financial experts believe that markets are efficient and they believe in the free market hypothesis. And when you said, he said, we don't have a free market anymore. That's exactly true.
No, we're not allowed. Yeah, we're not allowed to have price
Exactly.
discovery. And as soon as you come to terms with that, instead of fighting it, instead of being angry with the powers that be, Fed, Treasury, White House, right? Their job is to justify their existence and to generate tax receipts. A very healthy equities market attracts money from abroad. It also attracts money for their treasuries, which we need to fund our deficit. So they have incredible incentive, incredible motivations to backstop whatever happens to the equity market, because it is the wealth effect. The wealth effect is absolutely related to the economic success or failure as well of the United States. So people say, oh, the stock market is not the economy. Yes, it is. So even though we may not have, such a wide amount of people active in the stock market, the wealth effect that is generating the tax receipts and the corporations that are benefiting through their continued stock buybacks and hiring, it's very critical to hiring. So if we lose value,
and everybody with their 401ks, right?
But also just
IRAs,
the corporate being that engine of the market is bullish because of the earnings that they can generate to hire more people, and the reverse is also true. So we get into a backdrop now of global credit demand falling, and policy intervention is needed, and people are like, it's all a Ponzi. But okay, that's called, turf war. They're protecting their interests. They want to keep the economy and the equity market and the wealthy, all humming, so we don't have a financial crisis. Because that would this is the alternative. The alternative is no price discovery is allowed. Policy intervention is absolutely required, and that results in massive debt. And folks are very, very stressed about the massive debt. We're told to live within our means. The government obviously is not, and they're spending like drunken sailors. When does that stop? When that stops, actually, or when anyone comes into power that actually gets control of it, we'll actually have a healthy dollar again. We'll actually get rid of these speculative assets that are really draining a lot of this liquidity. In other words, they're not being used, the money is not being used productively. It will absolutely require productive use of dollars when we get control of this. And right now, until then, it is still free money for speculation in equities. It is still where it's still the best, dirty shirt in the laundry. And
The best dirty
yeah, and
shirt in
we're
the laundry.
definitely not allowed to have price discovery because of constant intervention callers or policy interference. And that's all there's to say about that.
Well, thank you so much, Samantha Leduc. Leduc Trading. Anything else you
Thank
want
you for the
to?
invite. And thank you so much for this. I mean, it's end of week and it's been intense, for sure, since markets are still trying to figure out what happens with the Middle East conflict, which is a big threat to some price stability, but mostly in the oil markets. And I wish everyone a fabulous earnings season because that kicks off next Friday. And now we'll get to really see how
That's a lot of fun.
companies are doing in managing their sales demand and also profitability and their ability to get credit. So we'll hear from banks pretty soon. When this is out, it'll be known. But I thank you very much for the invite.
Well, thanks for joining us. Hope to have you on again in the future. And I found this fascinating. You got me thinking too. There was this bank that just evaporated. We live in New Jersey, and all of a sudden it was taken over by Fulton Bank. It was called Republic Bank. One of the biggest insiders was Stephen A. Cohen. And you wonder what happened to that holding. But
we're not in the club. Okay.
Yeah, we're not in the club. And then all of a sudden, a bank that should have gone, now they probably have shares in Fulton Bank. And I mean, just talk about one day the bank was there, 100 branches, now 0. Oh, it's gone. Like, it's an amazing world we live in. But thank you so much. A lot of fun.
Thank you so much. Have a great rest of the weekend. Bye.